Everybody, and welcome to this week's edition of the Lincoln Property and Mortgage Show. As always, with me, Michael Hollenby from Hollenby Mackay Bespoke Estate Agents, and Jenny Holt from Your Mortgage Hub. So, hello, Jenny. How are you?
I'm a little bit rough today, Mike. I'm not even going to lie.
I pushed you straight into that, didn't I?
Yeah, you did. I knew that was coming. So it was our mortgage network conference yesterday at the NEC, and I was just saying to you, literally when the Hoovers come out to clean the bar area, I thought that's probably time to go to bed. So I am a little bit delicate today.
You mean from all
So
the hard work and networking?
yes. So everything is a bit of a struggle today, if I'm honest, but I'm sure we will get through it, and I'm sure it'll be worth it.
And yet, we're going to be talking about something quite in depth and very, very sort of as is the news literally as of this week, really. So we've got a great topic today, and actually, we're going to really benefit by Jenny's wisdom and experience here. So I tell you what, Jenny, let's run with the credits, and then let's get straight into this week's show.
Awesome.
So, Jenny, let's come over to you then. If you want to do as a quick introduction in regard to what we're going to be covering in tonight's show.
Yeah, so in tonight's show, we're going to be having a chat around what I saw lenders getting up to last week in terms of products and valuations and just sort of where they sit and really how that's going to impact you guys moving forward into 2024. For anyone that's got a mortgage or is potentially considering getting some form of mortgage in 2024, what that impact is going to look like in terms of a reality for you guys, really. So that's what we're going to talk about. Look, any comments you guys have, any questions, please just pop them in the chat there. Don't forget to put your name on because we can't see who's written that. So if you do have any questions or comments, just make sure you put your name on there before you post.
Fantastic. We've already got some viewers joining us this evening. So, as always, thank you to you as well. Now, this is the actual subject again this evening, Jenny, is when we were talking about this earlier today. This is actually, like we say, very, very topical, but also it's a huge step from where we've been in the last probably 24 months, probably even longer than that, because obviously we saw mortgage lending and the rates and almost everything sort of flatline for such a long period of time. We haven't really seen sort of the roller coaster of increases, decreases, stabilizing, Bank of England meetings, voting in regard to what's happening into the marketplace. There seemed to be, I won't say stability, but it wasn't really at the top of everybody's agenda on what we would have been talking about this time even last year. So I think that the fact that, again, this is really topical and is very much about what's happening in the first quarter of this year, piggybacks a lot of what we've been talking about probably now for 4 or 5 months about where we saw the market going into this year. And we've talked about the property market on there, but I think I'm really interested to hear tonight on what you're seeing happening in the industry in regard to lending. So let's just jump in with you then, Jen, if that's all right.
Yeah, absolutely. So I did a short video on this on Monday actually, and it was quite apt because then I went to the conference. And actually, what I was talking about was what we were talking about at the conference. I'm going to sort of go on with figures and things. I'm going to try and make this really real life for you guys out there watching this, which I think is really important. So, what did I see realistically? Last week is high street lenders are starting to put their rates up now. This isn't because they don't want to lend, because they really do want to lend. They've got the money to lend and they want to lend. What they don't want to do is be top of the tree every single time. So, like I've explained previously, lenders have buckets. And each bucket is for each different type of mortgage. So it might be a first time buyer with a 5%. It might be a first time buyer with 20% deposit, a remortgage, a buy to let. As those buckets get filled, then what will happen is the lender doesn't want to take any more or put any more money or take any more money out of those buckets. So they remove them. And the way they do that is they just increase the rates. Okay. So they just slowly increase the rates, and that puts someone else, another lender, allowing them to fill their buckets up. So we are seeing a lot of that happening at the moment. Now, there's lots of external factors that can impact on why a lender will do that. And we heard that grumbling word of recession last week, though. For what it's worth, I think it will be short-lived. I don't think it's going to be a 2008 crash that we saw, and most of the guys out there kind of agree with that as well. But we did go into a recession back end of last year. Now, as I say, the lenders don't want to be top of the tree, so they put the rates up. When we talk about the base rate and how this sits within the base rate, a lot of people automatically assume that they see on the news that the base rate has gone up or it's stabilised, and this will then impact on their interest rates. Well, you are right in one sense, but it's not that immediate correlation that we used to, or we feel that would happen. So I don't know if anyone awares, but the Monetary Committee meet and they decide whether they're going to put the base rate up. The last time they met, one of them voted to drop the rate. 6 of them said, let's keep it stable, which is what they did. They kept it at 5.25%. And there was 2 that looked and said, I think we should increase the rate. Now, I was listening to someone, an economic advisor for one of the big high street banks yesterday, and they feel that the interest rate with the base rate will drop. We don't feel that's going to drop until August. Okay, so the 5.25 is probably going to be there. And what they feel is that it's not going to be a downward climb, which is what I've been saying all along. We honestly believe that we are going to see interest rates go up and down, up and down, up and down. And that clearly shows with this example of these buckets that we see. When they get filled, they go somewhere else. And that's really key for anyone that is looking to get a mortgage. I've had lots of people that's come to me, they've left it and left it and left it, thinking rates are going to drop, they're going to drop, they're going to drop, and suddenly they've stopped dropping and they're on the upward trend at the moment. Now, I'm not saying for 1 second that they're going to keep going up and up, and we're going to have the moment we had when our lovely Liz Truss came into power and just destroyed everything within, was it 42 days? I don't think that's going to happen. So I don't think we need to worry there. But I do think that if you are looking for a mortgage in 2024, it's probably best to get a bit of a wiggle on to try and just slow rates. Yeah, sorry, Mike, what was you going to say? Sorry.
No, just to do it now, like you say, I'm talking to people as well, and they're saying, "Oh, we might move later in the year, or we might get a valuation now," and we'll then start looking around. And we spoke a few weeks ago about if you're waiting for rates to drop previously, you'd have been waiting 7 years. So there's always that things. If your needs are, and this is what you want to do, it's with anything. You've got to catch the bus when it comes along. So it's something that we've been giving advice for many weeks, and I think you're absolutely right, Jenny. Is if there's a need to move and you want to move, the products are there now. Like you say, we don't really sort of see them shooting up. We certainly don't see them shooting down. And I think one of the comments you said there about it probably not even being until the sort of summertime around about August. I think there's probably the conversation around obviously the general election, which I can't see that happening until sort of between August or even as late as November. And I think that will be a bit of a vote winner. I think there's a conversation about trying to ride out the property market and the economy again from a vote winner point of view to say, oh, look, beginning of the year, we were in recession, because statistically we were. Yeah. We've come out of recession. The economy is better. The interest rates are stabilized. We brought the interest rate down. That's the sort of thing, again, that the media and the politicians will be using to get people to go down into the balloting and to put the votes in. So I think all of these things are all starting to fall into play now. And as we know, we see the headlines and we know what goes on in the media, and we know that a lot of these things are forecast many months and planned many months in advance.
Yeah, absolutely. Look, and every politician is going to come in and say they're going to drop taxes, or they're going to try and save the consumer, us guys, money. And they probably will. It will probably be part of their manifesto that they will drop some form of tax. What that looks like, who knows? But by doing that, that will then have an impact on the base rate as well as the interest rates for everyone. So, there's a lot going on in 2024, and it's not just in the UK. Everywhere you turn, there seems to be some form of election across the world. And, America's got theirs coming up, and that will have a big impact on what we see happen over here in the UK. So, look, I am no economist. I don't pretend to be. For me, it's very much about what works for you guys. We can sit here and talk about interest rates till we're blue in the face. Everyone's got a different opinion.
Yeah.
The truth of the matter is it's that monthly payment that's really, really important. People say to me, I say to people, well, what's the APR that you're paying on your car? What's the interest you're paying on the car? No idea. Couldn't tell you. Wouldn't have a clue. But they can tell me it's 400 quid a month, because that's what's important to them. And that's how to look at your mortgage. We can get really bogged down in stats and figures if you what does that mortgage payment allow you to do, and what doesn't it allow you to do, and that's for me is the key, Mike, when we're looking at interest rates. It's not necessarily the rates, it's the monthly payment that
notes.
sits behind that rates.
Yeah, it's always about, what does that actually mean, pounds and pence in my back pocket? And am I right in thinking as well, Jenna, that, some of these lenders now are looking at how long you have the term of your mortgage for? Historically, when we were sort of, in our younger days getting mortgages, it was always like it was a 25-year mortgage. Whereas now, probably lenders, again, you'll know this better than me, but I see applications going in with providers that the lenders will look for a longer term than 25 years now, so that yes, the rates might be different, and that's the sort of thing that you're hearing in the headlines, but actually when it comes down to your pound notes again and what you're paying a month, that can have an influence there as well.
Yeah, absolutely. Look, there's 40-year mortgage terms out there. Now, I'm not saying you should all rush out and get a 40-year mortgage term, because obviously the longer the mortgage term, the more interest that you will pay. What I am saying, though, is when you're in a situation as we are as a country, and money is tight, and, when you look at the figures, wages might be on the increase, but they're still a lot further behind to where they should be. The growth isn't there. Then that interest that you're going to pay long term may not be the deciding factor. It may just be, can I pay my mortgage? You can have terms 40 years. There's lenders that will take your mortgage up to the age of 80. 75 is quite a commonplace at the moment. And the mortgage term is one of the most flexible things. So you can start off and go, we're going to have a longer term. And this is a conversation I have a lot at the moment, Mike, with my clients is, let's go for a longer term now. Let's know that you can afford to pay that mortgage. If you're fixed into a deal, it's one of the only things in your household budget that is going to be fixed, and it's not going to go up for that period of time. Let's get that sorted, and then in the future we can bring that mortgage term back down. So we might go for a longer term. We can wait until the remortgage is due, but with the term, as long as it's affordable and you meet the lender's criteria, that mortgage term can be increased or reduced at any point. You don't need to wait for your product to come to an end. It's a really fluid part of your mortgage. So, and we need to use the term to flex that household budgets and make sure that you stay safe and you get to keep your home. And we've all got to have a life. What is the point in just working? That's no life. So there definitely has to be a balance there.
Yeah, spot on. No, that's good advice as well. Thank you for that.
No problem. So the second thing I'm seeing, and Mike, this is really where you're going to step in as well, because you will see this as much as I see this, is lenders are lowering their risk again, because it's all about their risk appetite and how they can protect themselves moving forward. They are reducing house prices. Okay. Now, overall in 2024, we expect there to be about a 2% decrease on house prices. And a lot of that really is just a bit of a correction from what happened in those COVID years, where the house prices just shot through the roof, and it was going on at 400 and people were paying 450, 475, and it just went crazy. So though there is a bit of a drop we think we'll see in 2024, it is only 2%, okay? And it's really just going to level it back out to where we were in COVID years, really. But what we're seeing at the moment is the way that they protect themselves is, if there is that change in the market, they've still got that equity, that deposit that you've put in, they've still got that change. So, for example, if you've got a £100,000 house and the market drops and they've valued it at 100,000 and you've got your mortgage for 100,000, then potentially you are now in negative equity. If the lender reduces that down to 90,000, what that then allows them to do is have that extra bit of wiggle room just in case the market drops. So in terms of how that impacts on you, sometimes it can be great when you're looking to buy a house and they've downvalued it and you can renegotiate with the estate agents for the lower deal. But sometimes, everyone has to move. And if we can't renegotiate it and you really want to buy it, that means you have to find that extra deposit. And sometimes, unfortunately, that does mean that we can see those sales fall through. Mike, I'm assuming you're seeing a little bit of that from your end at the moment.
Yeah, definitely. I've been out and attended some surveys recently on some of my house sales, and the surveyors, it is a very detailed report now we're seeing. What I'm seeing to start off with is desktop valuations, which are, very, very common, where, you put a mortgage application in and the surveyor would look at comparable evidence and would often work off comparables and what we call a desktop valuation, where they would either just literally approve the lending because of either the loan to rate value, or statistically the comparables were saying, yes, it has increased in capital value over these years and we anticipate it doing the same. Or they'll do what we call a drive-by report. So they'll get the desktop valuation, then somebody would physically literally go out to the property and drive by and make sure that, there's not a building site next door, or, a contaminated area, or there's something that would detrimentally affect the value of the property that can't be seen from, a desktop valuation. So we were seeing lots of those, but what was starting to see now is desktop valuations, drive-by valuations, and then a second call for an actual physical valuation at the property as well. And I've experienced 2 of those in the last week, where I've had to ring back up homeowners and say, look, yes, we've agreed to sell, you have had a valuation done on it, but now the surveyor wants to come in and make another appointment to meet with you. So it's having to educate those homeowners to say, look, nothing to be necessarily concerned about. But what it does mean is there is more sensible lending back into the marketplace, and that lenders are being a little bit more careful, because we can't predict what's going to happen in the future. And I personally feel that it's probably better lending, because we remember those years before when people were in negative equity, and you could get 100, 105, 110% mortgage, because it was all based on the fact that for the last 2 or 3 years the capital growth was just flying up everywhere, because people just sell for what people are prepared to pay for. So I think it stabilizes things. I think it is a case of having to educate people on what's happening and why.
Mhm.
And it can work, in favor for everybody at the end of the day. Like you say, if it is a down valuation, we're not seeing huge numbers, they're not dropping tens of thousands off, but they are being very careful. And that again is why it is so important that you deal with an estate agent that knows how to deal with those renegotiations. It's something we spoke about even only last week, that when you get that scenario and a chain has to negotiate, because sometimes it can be somebody at the bottom end of the chain that has a down valuation, and somewhere along this chain of the whole people above and below, there's often conversations to say, look, we've had to come down by 5 grand. Could you help us in this, because we're at our limit now? Perhaps if I can negotiate with you and you can negotiate further up and somebody else can negotiate, if everybody takes 1,000 in there, it can all be passed back on again. So that those types of negotiations will be happening. They're bound to be happening more, certainly in the next 6 to 12 months. And I think it is important that, again, the agent, when they pitch the initial sort of valuation to you, again, is able to substantiate and back up those figures. They negotiate your sale the best way they possibly can, which again we've spoken about, when you've got the buyer, but also you've got an agent who's experienced enough to know how to renegotiate if that does happen.
Yeah, absolutely. And I think that is key. I speak to a lot of my clients and they're like, I don't really want to approach the estate agent. I feel like I'm being a little bit cheeky, but it's not, it's perfectly normal. It's all part of that process. And that's why, again, when you're choosing your estate agents, it's being able to have those honest conversations and being able to trust them to do what's right to make sure that that whole chain gets to move there, which is really important. The other thing to consider is if your house price does get reduced, it does potentially mean that let me explain it in an example. So recently I had a client who was looking at a remortgage and they valued the house at 190,000. Then when the valuer come round, they'd reduced it down by 10,000. But what that 10,000 actually did is, rather than putting them in this interest rate bracket, it now put them in a higher interest rate bracket, because your interest rate is based on your loan to value. And if you can remember me explaining previously, the loan to value is about how much the property is worth and how much mortgage you have on it. It's that calculation, that percentage. And the higher the loan to value bracket, the higher the interest rates. So you will see potentially a change in products. And the thing to consider at the moment as well is, because we have the products changing on a regular basis, if it's taken a little while to get the valuation done, those rates for that next bracket has potentially gone up as well. So that can really impact. And I can see we've got a comment here come through. Not sure who it is, but thank you for putting a comment on. Then we've got, can a limited company buy a property? So yes, a limited company can buy a property. We're seeing a lot of this at the moment. They are investment properties in essence. So you would set up a what we call an SPV limited company, and you can buy a home to invest in that. The other thing, just to confirm as well, is you can use your limited company accounts to purchase a residential property, which is a slightly different, well, it's a very different scenario. But yes, in essence, a limited company can buy a property as an investment value, or you can use your limited company accounts to buy your residential home.
Okay, great question. I thought we'd just put that in there because obviously that was coming through as we were talking there, and again we've had a nice like and a thumbs up from Jack as well this evening. So again, thanks everybody. And again, if there's any more questions, do keep firing those away. So we were just talking there again about loan to rate values, which I hope everybody has a bit of a clearer understanding. Like you say, the higher the LTV, the higher the rate in essence. So anything else there, Jenny, that you also then want to add on to as well?
So I guess for me, I think 2024, I've said it all the time, is definitely people that have woke up on the 8th of January and went, I'm moving, or I'm going to sort my mortgage out. This is the year. Don't be afraid that rates may be going up slightly, because that's just part of the course. I'm sure we will see this all the way down, up in rates all the way through the year. It's about, like you said, Mike, catching the tide in the right time. So I would say that if you are looking at mortgage, look, it's that monthly payment that's critical. Start the process now, because you never know quite how close you are. I speak to a lot of people that go, I can't buy till the end of the year. And like, well, why is that? What makes that decision? Who's told you that? So speak to your mortgage broker, see when you can actually buy and what is possible. Make a plan, because I promise you 2024 is going to be a really good year in the mortgage world. We just need to give it a little bit of time. And at the back end, we may see those rates start to come down. But I think we will see interest rates for you guys as a consumer. I think they will just go up and down all year. So we just got to make sure we're prepared to catch the tide when they're on the way down.
Fantastic. So I think that, some great insight again, as ever, Jen. I think really, really helpful information. It also just ties in, as I say, into a lot of the subjects and conversations that we've had with people, certainly again, even over the last sort of 4 or 5 months. So I think there seems to be a bit of a continuous theme on what's happening just in regard to the property market, where we've looked at Lincoln recently. There's been some reports recently that house prices have gone up by about 1.3% after only the first couple of months of this year. What will be interesting is to see how that pans out with actual sale agreed prices in a further 3 months. And also, just off the back of that, although house prices may have gone up, that's just on listing price, not necessarily sale price. So that's going to tie in again exactly what you've just said in tonight's show as well, Jenny. But what will be more important is when we get to October, because the land registry data stats are 3 months behind. It takes 3 months to get that information. So when we're looking at data now, we're looking at stuff that happened, in October, November of last year. We already know what happened in that market. It stabilized and prices were coming down. We were actually seeing asking prices come down by about 3% every 8 weeks. So it's not going to be until we get to, the back end of this year before we actually find out exactly what was happening, sort of, even now, on what properties are coming on the market now to sell, and then go through the land registry data. So I think ultimately it's about getting the right advice from your mortgage advisor, your bank, your lender, and your estate agent, and be it whether you are looking to put your house on the market, or whether even if you are on the market with an agent at the moment, is getting regular updates and advice. So I think we've covered quite a lot in today's show as well, Jenny. So thank you, very much. There's a lot of helpful information. Like Jenny said earlier, if you've got any questions, you can always come back to us. You can find us on our social media as well. I say this every week. Please make sure you follow Jenny in particular. Some of the content that she's putting out again on all of her social media platforms is very, very relevant. It's as and when things are happening. Follow me, and I'll let you know what's happening into the property market and all the new listings that are coming available, sometimes 2-3 days before they go up on the websites and the portal. So lots and lots happening. But if we can help you at all, please reach out to us. Always happy to help. But again, thank you for watching today's show. If you're watching it and you've just got to the end of it, please like it, please comment on it, support us that way, tag somebody who you feel might be of interest as well. Last week's show had a lot of engagement and interaction with the topics that we were talking about last week. So thank you very much indeed. And we will look forward to seeing you again, same time, same place, next Tuesday at 7 o'clock on the Lincoln Property and Mortgage Show.